allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
All right, Vicki, can we have a roll call, please?
Yes, Commissioner Blaney,
Yes.
Commissioner Good, Commissioner Biggs, Councilmember Rivas,
Here.
Councilmember Graham,
Here.
Councilmember Jessen,
Here.
Councilmember Brickner,
Here.
Councilmember Wagner,
Here.
Councilmember Sims,
Present.
Councilmember Bozak,
Present.
advisory members Mark Ritzie,
Here.
and I don't see the other two here, so we do have a quorum of foundation members present.
All right, thank you. We'll move on to the approval.
Motion to approve the August 30th minutes.
Got a motion and a second. All those in favor signify by saying aye.
Aye.
Opposed, same sign. Motion carries. Okay, new business. We have the Capital Cities presentation.
Okay, good evening, everyone. My name's Amanda Black. Good to be here again. Thanks for having me. I'm going to cover a kind of what we'll call a flash report because of the timing of this meeting happening just a couple weeks after the end of the quarter. So I'll go over an abbreviated report of the third quarter results. Then I've got an update for you on the portfolio construction project that we've been working on kind of throughout the summer and into the fall on alternative investments. And then I'll show you the investment policy statement update that we've brought to you, and I'll explain that a little bit more here in a second. So just if you turn right in behind the first cover page, what you see on this page, okay, so this is just a market overview. So the results on this page are just broad indexes across the market. These are not Porter County's results. What you see are just kind of how different styles of investments performed during the third quarter and over the year. So the blue bars represent one quarter ending September 30th, and the gray bars represent 1 year ending September 30th. Not surprisingly, you see a lot of negative results here. Unfortunately, we've seen a lot of continued stress in the investment markets caused by inflation and the aggressive rate hikes by the Fed. Those two things really have just led to very poor performance across all investment styles. There truly has been no place to hide. All foundations, pension plans, 401ks are in this same situation. But to put a couple numbers in perspective, the very first bar there that you see on the left-hand side it says large cap core. That's the S&P 500 index, down about 5% for the quarter, almost down 16% over the last year. If you go to the very far right of that same chart, international markets are down much more. You can see down 25% over the last year. And then if you look at the bottom of the page for fixed income, even though equity or stocks have done much worse, fixed income is really a more notable story. If you look there where it says aggregate index,
Way in the front.
that's the broad fixed income aggregate index, down 14.6% for the 12-month period. That's the worst 1 year period of performance ever for the fixed income market. Again, this isn't the Porter County portfolio, but you're certainly affected by this. I just wanted to put the results kind of in perspective. So if you go behind tab, oops, excuse me, I don't want to skip that. The very next page shows Porter County's specific results. So again, this is an abbreviated report because of the timing. We will follow up with your full detailed report here in the coming weeks once it's completed. At the top in the blue bar on the next page, you see the total portfolio ended the September 30th period with a market value of $153,747,691. The return for the quarter was a negative 4.9%. The return for the 1 year period is negative 15.9%. While that's certainly disappointing performance, it is not at all surprising given what the markets are doing. And interestingly, your portfolio is outperforming its benchmarks. So had you just passively invested all of these strategies, you would have been doing worse. So what that means is that the active managers, the different mutual funds that you've selected for this portfolio are doing better than their benchmarks. But that's not much solace when we're looking at these negative numbers, but I did want to point that out. And over all periods, 3, 5, and since inception, you are beating your benchmark. So since inception, so going back to April 1st of 2016, this portfolio has experienced a positive return on an average annual basis of 4.2%. So despite this very difficult period, there has certainly been additive performance going back the full history.
Can I ask a quick question?
Sure.
When you talk about our total portfolio increase since, is this just the market value? Or how does the money that we took out and used at the county fit in?
Oh, sure. So that does not affect performance numbers. So these are all just simply investment performance numbers. If money is taken out, it's just kind of a wash. Like, we don't assume that we don't give any credit to that nor take any away.
Okay.
And normally on your full report, you'll see this. There's a chart that says, here's what you started with on April 1st, 2016. Here's how much you've taken in, or, taken out, and then here's how much has been added because of investment returns. That's just not in this abbreviated report, but you'll see that here in a couple weeks. So any questions on performance?
I have a question.
Sure.
It'll get better, right?
Yes. Eventually.
My mother always said.
Eventually.
Eventually.
Eventually. Hey, we're earning
Days are
4% on one-year CDs right now. Right, Mark? Your cash earned 0.5% over the last year. That's a big improvement from last year. Okay, so let's move to the next presentation, which is the alternatives follow-up. Now, this is something that we've actually been talking about for a couple quarters. So it may seem like I'm just, briefly covering this, but this is something you've already seen and something we've already thoroughly discussed. Because of that, I just want to kind of remind you where we are and see what kind of feedback or what direction you want to take this. So if you look at, and this is the alternatives follow-up. It's So on the executive summary, let me just remind you that we look at the asset allocation of the portfolio every single year. The mix between equity and fixed income and cash, and kind of underneath that, the different styles that are used and all of that. We're always trying to think about how to be as diversified as possible, but also to earn a modest return that meets the needs of the county. What we brought to you earlier this summer was the idea of considering alternative investments as a means for return enhancement, but also risk improvement. So again, not trying to swing for the fences, but trying to think about how can we diversify this portfolio as much as possible within the confines of the statutory guidelines that have been outlined for you. So we brought you a couple ideas of alternative investments. We did a deep dive into that last quarter. And now what we've done is kind of brought this back for further discussion. So one thing that we've done is we have taken your investment policy statement and we've mocked it up just to show you what it would look like if you decided to move forward with alternative investments. You would have to amend your investment policy statement just in a couple places to make that an allowable choice for this portfolio, so that would be a board vote. The other thing we've done is just updated the performance charts to show you how these managers have continued to do. So we have 3 specific recommendations on the table, and they're in this book. So if you go to page 6, I'll just remind you what that is. It says composition of recommended structure. So let me make sure I'm telling you So what we're recommending is that you take 20% of your portfolio and you allocate it to these 3 alternative managers. Almost half of that allocation would go to a preservation-oriented manager, so a fixed income, private credit alternative investment. The other slices of the pie would be split between an appreciation-oriented manager and a real return-oriented manager. And those are detailed in the box to the right. These are all ones we've talked about, pretty extensively. And there's also detail in the grid below that on page 7. So again, the reason we would suggest this is that we think you can reduce the overall risk of the whole portfolio by introducing assets that look different than stocks and bonds. We think that over time, this could lead to improved risk-adjusted returns. The reason you would not do this is because there's higher complexity and higher operational kind of considerations or complexities for you to think about. There's no free lunch in investments, so you have to kind of weigh those pros and cons. So if we were purely in a vacuum and just looking at the risk-return attributes, we would say this is a no-brainer. But you as a board have to weigh whether this is the complexity you wish to undertake. Other peers your size, other foundations across the country with over 150 million in assets are absolutely investing in these types of assets. But those are the types of things you need to weigh. When I talk about complexity, I would consider that kind of in two categories. On the one hand, the investments themselves are more complex. We're talking about kind of more nuanced strategies, long-short equity, private credit, et cetera. I would also refer to the complexity as being operational related. There are more documents that you would have to sign to invest in these strategies. The fees are are higher. And then the reporting needs and kind of oversight are higher. So those are all the things that you as a board have to contemplate when looking at these strategies. If you'll remember on page 9, we kind of dug into detail on what each of these funds does, the types of investments they hold. I'm happy to go into any detail on that. I just wanted to remind you of that page. And then I do want to also show you some updated performance. Now again, this is not Porter's performance. These are strategies that you don't own, but with our software, we're able to model out what it would have looked like had you put these in your portfolio. So that's what you'll see, like, for instance, let's look at page 15. So page 15 shows you, and if you look there on the left, you're going to see that there's a missing gray box. That's just because peer data is not yet available. That's part of the kind of holdup of not having your full report yet. But the numbers in the table below are accurate. We just don't have the full peer group to populate that gray bar. So what this shows you is that the 3 quarters ending September 30th, also known as the year-to-date period, if you had included these in your portfolio, your return would have been negative 15. Because rather than the return that you did experience year-to-date, which is negative 18.9. Now, is it always going to look like this? I can't predict that, but these managers would have kind of helped offset some of that negative return, but they wouldn't have erased it. When you're talking about just adding 20% of something, it's just a diversifier. It's not going to completely change the outcomes. So I did want to just kind of show you that they would have been additive. They would have offered downside protection. And that is why that's what we would look for them to do in the future, is these types of strategies would look different than the broad stock market. They would tend to lag when the stock market is going up, but they tend to outperform when the stock market is going down. So I've said a lot there, but I want to hear what kind of questions you might have or kind of what detail you're seeking. And I'll pause there.
You said that it would cost more.
Yes.
Do you have any figure on?
Yes, so right now, your weighted average fee, so if we take every one of your underlying investment managers and we weight them, the weighted average fee is 46 basis points, or 0.46%, so just shy of 0.5%. That's really low. If we were to take out the 20% pro rata from those managers, reallocate it to these 3, the fee would be 64 basis points, so 0.64. So that is a notable jump for you. I will also mention, however, that like on page 15, all of those figures are net of fees. So we would still expect their benefit to outweigh their cost over time.
And would it be 0.64% on average or just for that 20%?
That would be the entire portfolio. Yep. So your overall fee right now is 46 basis points. Your new overall fee would be 64. And the fees are listed on page 7 for each of the managers. One of them is 1.5%, one of them is 0.98%, and the other is 1.64. So that combo is, I think that's around 1.3. So that's what bumps up the total. With that said, those are very reasonable fees for alternative investments. These are not funds that any one of us could get into on our own. These are funds that only the largest foundations and pension funds are able to access, and because of that, you're able to access those lower share classes. Typically, when you're looking at alternatives, you're looking at 2% fees, 20% performance fees, and these are much lower than that.
I have one other question. You said that we would have to sign, there would be more signing?
Yes.
Would it would take all of us?
Yeah, that's a great question. So if there is a page that, let's just land on while I answer that. It's page 11, or excuse me, 10. We tried to think through what might those operational complexities be. And when it comes down to it, to implement with these funds, the Cliffwater Fund is actually just identical to a mutual fund. That'd be very straightforward. But the North Rock Fund, they do have a subscription document. That's something we have helped other clients of ours complete. You only need one person to sign it,
Oh, okay.
perhaps two. It might be two. But they do collect driver's licenses of those signers because of the Know Your Client rules within money management. So there are pretty extensive documents. That's something that as your advisor, we help you with, but ultimately you're the one signing it. So, you might want someone to give that a review. Of course, we'd walk you through it. The other thing to think about, and I'm looking at Michelle and Vicki over here. In terms of the market values and the statements and the performance, they're not always available immediately on a day-to-day basis. There is a reporting lag for some of these investments. So like the North Rock, I think it has a 20 business day reporting lag. So those are the types of things we'd want to walk through if that would cause any problem with your statements and your kind of month-end processes. So other investors.
What did you say?
In terms of our annual reporting,
Yep.
we're pretty flexible in terms of
Okay.
when we get that together. Like right now, we're going through the audit for the 2021 statements. And so that's a little bit later than normal. So if
Okay.
it's, you said a 20-day
20
lag,
business day lag.
that should not be
Okay.
a problem.
Yep. So that's something,
Good to know.
if you think about all the university endowments that invest in private equity, this is nothing like private equity, but, they're often reporting on a 3-month lag. So, but I still wanted to mention that because that's different than what you're doing now.
Okay.
So this is something, I just want to remind you that as your advisor, we have no skin in the game on this per se. I don't know a better way to say that. We have no affiliation to investment managers or banks or brokers or anything like that. You just pay us a flat fee for our services. So this doesn't, make a difference to us to push this on you, other than we want your best interest in mind as your fiduciary of these assets as well. So we want to make sure you're aware of these types of assets, that you consider it, that you have education on it, but ultimately you hold the decision of whether or not to do this.
Well, I spoke with Matt Vesely, one of our advisors, between the last 2 meetings, and he spent some time looking through this and felt like it was a positive and would advise us to move forward. But I'd be interested to hear what you have to say, too.
I forwarded you from our investment.
Oh, yeah, yeah.
So that would be what I would have to say. It's not good or bad, it's just timing, right, in the market, but also I think some of the funds weren't liquid,
and so that could be an issue. But for the most part, the bigger institutions, according to our person, they are doing that. I honestly don't, it's above my pay grade for you to give a good, solid answer
Right.
how that would all play out. It looks, to me, the investment side of it doesn't look like it looks like it's marginal as to the loss or to the gain. So I guess it really just depends on how we time it and what, if the market's going down more, then it sounds like we should jump in right now. And if the market's going up from here, it sounds like it's really kind of one of those. I could be
Yeah,
wrong,
so
but
that's a tricky call. From my perspective, we're thinking about this foundation into perpetuity. We're talking about very long-term strategic decisions, and we're absolutely not trying to time the market. If I were able to time the market, I wouldn't be sitting here.
Well, maybe I
trying-
didn't mean it quite like that.
Right.
but
Yeah.
It just seems like that's kind of what we're looking at, right? As the market drops, we're trying to add options so that we
Protect ourselves a little
right
bit.
on the downside.
Well, and the way I look at that is this foundation has been, made a very huge move in 2016 to start investing in equity. It took a lot of time and effort to get everyone on board with that. Then there was a decision to increase that equity somewhat over time. And now this, to me, seems like the next logical step as the foundation is kind of growing and evolving to being more like a true institutional, foundation of this size. I also, decisions like this with boards take many months and quarters. By the time we got through the final investment policy statement and all the documents, the market could move again. So I am aware of it and I get what you're saying, but that's not the intent, is to time.
So it seems like this would cost a little bit more money, but the potential reward could be greater, correct?
That's the hope is that you would have a smoother ride and a slightly better ride.
Okay. But if we don't do this, with the amount of rewards, so is that we about the same?
Well, I mean, we can back test that. Of course, I have to give you all the disclaimers that I can't predict returns into the future.
Right.
But look at page 14. So what this is showing you is this, had you done this back when you started, you would have earned 5.0% instead of 4.1. Now, that's per year, so that's 90 basis points a year times 6 years. So then that starts to become very real money.
Right.
And if it reduces your risk along the way and, kind of gives us all less heartburn when the markets do what they're doing now, then that's a benefit too. But again, we're not swinging for the fences. We're trying to stay within your very specific statutory guidelines, which are conservative.
Scott, did you have something?
Yeah, I just wonder, I guess we've gone down the path of how we got here, but I know we're in a market right now that is, the topic of today is what the market's done the last 3 or 6 months or so, or for the year. But, ultimately, the reason why this came up was to be able to have a further tool to diversify. And so, and at our size and at our complexity, even these small differences, when they're reducing our potential downside, leveling it out, we do lose very marginally some upside over these years, but ultimately, having the additional diversification along with just the last example of 50 basis points or whatever it may be over a period of time at our amount of principal is significant. Especially when we go back to the last time we moved equities to the level to which they are now. We all know what that long-term investment rate was, which is why the amount coming out every year was set. So very small amounts do make a big difference here as far as overall return year after year.
So, what kind of stomach does this board have right now? Do you need to spend some more time with this? Do you want to act one way or the other today? What are your thoughts?
I'm not prepared to move forward with anything different at this point.
I kind of agree. I've asked a lot of questions, but now I want to really dig into it to see.
Sure. Maybe I could just let you know what's in this book as you're doing that. So we have all of Capital Cities material, so that's kind of where we're giving you our thoughts, our analysis, the why, the considerations. But then also, please note that at the back of the book, we've actually included literature from each of the fund managers so that you can see, their decks, the ins and outs of these funds. Just know that that's all in there for your kind of perusal. The other thing I want to point to, and you don't have to pull this up on the computer, the very, behind tab 2 of the hard copy book is the investment policy statement if you were to go down this path. So you might want to make a note on that it's the one behind the 2 dots. This is the one that you would be reviewing should you implement 20% in alternatives. So that's there just so you can kind of see what that would require, because you would have to vote on that.
I'm fine with waiting, Madam Chair, but I think 14 really, page 14 tells the story of what we're missing on the upside and what we're saving on the downside. I think at some point in time in the near future, we should definitely act on it. That's my opinion. And 14 tells why.
I agree, and I would like everybody to please take a good look at this before our next meeting and try to be ready to act on it. This one kind of snuck up on us. At budget time.
Yeah, and I think, this group has done such a great job of, kind of putting your toes in the water with these investments over the years and getting this to where it is today. I think this is a next logical step to consider. Doesn't mean you have to do it, but we wouldn't bring it to you if we didn't think it was additive and diversifying.
I appreciate all your work on this. There's a lot of great information in here for us to consider. Do we have any other?
I have a quick thing on a different topic.
Okay, go right ahead. Any other questions on this one while she's still here?
No, I might suggest, though, that it would be helpful to perhaps prior to the next meeting on this particular topic, which is it's a hefty topic, it's a significant change, that if we could have perhaps a committee of people get together and some from the Commissioner's Office, counsel, our financial advisors, our attorneys could be involved with it to ferret it out and perhaps come prepared with a recommendation at our next meeting. That might help expedite.
Well, do we want to set up a small committee to do that right now, since we're all sitting here at once?
Is there another meeting this year? Or is,
No, this is
Not
our last
normal.
one.
This is the last one?
Yeah. I mean, unless we schedule an extra one. Who wants to? Mike, I'm sure you'd like to be in that committee.
Happy to be on.
I'm looking away.
2 presidents, 2 vices, and a lawyer.
Who? You want to
You
be on it?
guys.
I'll be on it. Anybody else like to be on it? Mark, would you like to be on it?
And for the record, we weren't against the investment at all. It was just.
No, I didn't feel like you were.
Yeah. I didn't want it to appear to be that way.
Oh, he's way against it, way against it.
The hesitancy has changed, right? So that's.
Anybody else on the council interested? All right, party of 3. We'll talk.
Okay.
All right, you said you had something else?
One other kind of quick thing, but a very important thing. So the very last tab, this is the investment policy statement. Let me make sure. Okay. Yeah, I believe that's the right one on the screen. So every year, part of our job as your advisor is to look at your investment policy statement and make sure it's still doing its job. Ideally, we're not making wholesale changes to that year to year, and we're not this time either. With that said, there are things that get updated just as normal course of business in the appendix. So if you find page 15, the appendix starts right after that. What you see here is just a red line version of what's changed. Things like the market value, just updating the roster of the board members, updating any kind of areas where we have, like the name of a benchmark, like an index that has changed. You know, for instance, the Bloomberg Barclays Index is now just the Bloomberg Index. Things like that. So these are all just housekeeping changes. With that said, I always like to remind boards that this is a great opportunity to reread through the investment policy statement. Make sure you don't see anything else that you think needs attention, because this is the guiding kind of controlling document of these assets. So no vote is needed there.
I do have one.
Oh,
So
sure.
in our investment, and maybe this is explained in here, is there a place where we could have done different to make those numbers, in other words, in the equities investments, or in the fixed income investments where we lost money? Is there a way to look at that and say, well, if we had done this in that same investment or in a different investment vehicle, could have outperformed or under-lost in certain categories? Does that make sense, instead of comparing it to necessarily adding a new investment strategy altogether?
Oh, sure, that's
Does
what we,
that-
yeah, okay. So you're asking,
So- Just from and again, layman's terms maybe, if we had invested in something else in the equities market, we wouldn't have lost as much in that realm, or
yeah, that's.
does that make sense?
Yes, absolutely. So in the flash report, what we do, so we have a very customized benchmark that basically takes your exact asset allocation. So your exact amount of U.S. equity, non-U.S. equity, core fixed income, short duration fixed income, cash, all of those things. And it assigns the appropriate benchmark for each of those asset classes, and then it's weighted according to your asset allocation. We then compare your performance, your actual performance against that, and that's where I was saying Porter has beat its benchmark every single period since inception. So that tells you that had you just invested passively, you would have done worse. Now, that's not saying, if I would have bought Goldman instead of BlackRock, would I have done better? It doesn't get that fancy, but it does tell you that you're beating your benchmarks. We also look at every single one of your underlying managers compared to their respective benchmark, as well as compared to a peer group of other managers doing the same thing. We always want to make sure your managers are in the top half of their peer group. There will be times where they're not, and that's when we come to you with a write-up or a reason or discussion. All of those control procedures are also outlined in your investment policy statement. So all of that, all of those details of kind of how we look at that, why we look at that, and then what we do if it's not where we want it to be, that's all in the investment policy statement.
Anybody else? All right.
Okay,
Thank you very much.
Joy's, is there a question? Oh, that's fine. Thank you.
Should we set the next meeting while we're here? That seems to work pretty well.
Yeah.
We're looking at the first quarter of 2023. Should we do the January or we get later? We have until the end of March, right?
This calendar doesn't go into January.
Fourth Tuesdays. Probably not March because that's usually spring break
Everybody
problems.
goes on breaks.
January, February, what do you think, guys?
February 28th for our council meeting?
February 28th, how's that look?
Sounds good.
That seems fine.
February 28th, does that work for you too?
I think so.
Okay.
It's strangely open, but it's early.
Lock it in.
If not, I will, just let us know. And we'll
Okay,
figure
let
it
me
out.
double check a couple. Yeah, I think it should be.
Meantime, I'll make a motion to approve the claims, Capital City's third quarter, $16,250, and the Katz Sapper Miller, the progress bill of $5,000.
Second.
Is there any question on this CATS, Sapper and Miller? Is this accurate?
Honestly, I didn't really look at, but I think it's just the regular progress reports because they're the auditors for our financial statements. And there was quite a bit of audit work for the 2021 statements,
Okay.
2020.
All right, we've got a motion and a second. All those in favor signify by saying aye. Aye. Opposed, same sign. Motion carries. And that's all we got.
Motion to adjourn.
Excuse me, Laura, can I just say one thing?
Absolutely.
Because this is an early meeting in the quarter, I just want all of you to know that I'll be sending you our Form 990 in the coming weeks before I file it. That's your annual tax return that we do in-house, I do. So please watch that, please review it, because it's one of the control questions that I answer, that the board does review the tax return before it's filed. And so I'll be putting that together
Motion on the floor.
in the coming weeks. And with that, I'll just note this is my last foundation meeting.
Hey, mine too.
So, but I will
Well,
be
great job.
sending
Thank you very
everyone your
much.
Form 990 for
He's
you.
running for,
All right, you got a motion on the floor to adjourn. Do we have a second?
Yeah, we did.
you already had it.
All right, meeting is adjourned. Thank you.
How in the same sentence you spell my name wrong?